Good afternoon, everyone, and welcome to our webinar, FRS 102, Get Ready for UK Accounting Changes. My name is Lucy Tolton. I'm a director at BKL, and I'll be moderating today's session. We're delighted to have you with us as we explore the upcoming changes to FRS 102 and what they mean for UK businesses. Before we start, just a quick note, this session is being recorded and the presentation slides will be shared with you afterwards. If you have any questions during the webinar, please use the Q&A button at the top of your screen. We'll do our best to address as many questions as possible during the dedicated Q&A segment towards the end of the presentation. We've got a lot to get through, so I will hand over to Aron, who will introduce himself, David, and walk us through today's agenda.
Thanks, Lucy. Really happy to be here today. My name's Aron Kleiman. I'm one of the partners at BKL's audit team. And together with David, I've been leading BKL's project on the upcoming changes to FRS 102. David.
Hey, everyone. I'm very happy to be on the call today. I am the Director of Technical Accounting and Quality here at BKL. I'm co-leading the implementation of FRS 102 changes with Aron, and I have a background in FRS reporting for a number of clients, which should be a useful perspective as the similar changes that came into FRS a number of years ago are rolled out into FRS 102. So I just kick off with some of the key takeaways from today's session. It's very difficult within our session to cover off absolutely everything, but there are a number of key takeaways that we want to make sure that members on the call definitely take away and give some thought to after this webinar. So the headline really is that there are new lease and revenue accounting rules coming into FRS 102. They are mandatory, and the new lease accounting model will be quite widely impactful for a number of clients. Any clients that have any lease of any description, whether or not they rent their own property or they rent motor vehicles or equipment, there is going to be an impact for those businesses. From a timing perspective, the changes are mandatory from the 1st of January 2026, and just to clarify, that's for accounting periods commencing on or after that date. So likely that 31st of December 2026 year ends will be the first tranche of companies impacted, albeit early adoption is possible, and a number of clients have taken the opportunity to early adopt for various reasons. In terms of wider impacts, there is potentially impacts if these changes are impactful on areas such as EBITDA, profit, and gearing, and any performance-based metrics or schemes that the companies may have in place with employees, and we'll touch on those. We'll touch on those later. Yeah, so they are massively impactful changes. The most impactful changes to come into FRS 102 since it came into existence 10 years ago now. And unless your business is very simple, there will be some action and impact assessment required just to get ahead of the changes and be aware of how your results may be impacted. And from a practical point of view, the requirements definitely will drive changes to impact on finance systems and controls. There will be a number of new data points, and the processes and your teams internally need to be set up to be able to capture those data points effectively and in the right way to ensure accurate reporting. And then just a final note on potential opportunities. You may not think a change in accounting standards could create an opportunity, but some companies may be playing with the idea of converting to full IFRS, and rather than potentially adopt these two major changes which came into IFRS 5 or 6 years ago now, companies may just decide now to take this as an opportunity to fully convert to IFRS for a number of reasons, normally tied to strategic or growth reasons. They may just want to prepare under IFRS, and this could be an opportunity to do that.
Yes, thanks. So that's what we would like everyone to take away from today. So threaded through our presentation, which will of course focus on those key changes to leases and revenue, but we'll touch on all those wider impacts too. Technical accounting is what we're here for today. We'll make sure you get that The timing is key to understand. Several of the changes we'll talk about roll out with slightly different timeframes. So understanding that and then the impact on your own reporting and processes is key. Those wider impacts that David touched on. What do I need to do if I'm working in a business today? Systems, controls, documents, what do I need to think about? And the opportunities, David touched on the opportunities for you, but there's great opportunities for us to expand our relationship with you as well. And we at BKL, across the service lines that we offer, are here to help, fully informed about these changes and knowing how they can impact you and your business. So let's get into the real technical side of things. That's why we're here today. And thank you all for joining for that. Leases. So the critical point, and we're going to explore this in depth in a moment. Most, I would even say virtually all leases from when this change is implemented are going to move onto the balance sheet. The concept of operating leases effectively is going to disappear from FRS 102. So companies should expect higher assets and liabilities. Net assets may look the same, and we'll touch on that in a moment, but taken on their own, you'll have higher gross assets and higher gross liabilities. And there are significant changes on EBITDA as some of the expenditure changes its profile as well. We're going to talk about revenue, the move to the 5-step model. Those familiar with IFRS 15, that's the move that FRS 102 is making. Timing of when you recognize revenue may shift earlier, later, depending on how your contracts are structured. Disclosures, what's going to go into the financial statements, and that's where we can really help out. More transparency will be required, and there's more that's going to be demanded of even small companies that have historically enjoyed fewer disclosure requirements. We are going to talk about the change in company size thresholds and how this affects things. This is already in force, actually. It came in April 2025. Many here will be aware the change was to increase the monetary threshold, so revenue and gross assets, by 50% to measure a company's size or a group as small, medium or large. And a reminder that the employee threshold was not impacted by this. That remained the same. So if I talk about the timing, just so you have an idea, we're in 2025 now, as I noted. April 25 was when the change to the company size threshold came in. I did want to flag really briefly the 2-year rule, whereby it's the second year of breach where the new requirements kick in, both on the way up and the way down for companies, is made quite complicated by these changes. And we would advise that you consult with us if your company size is on or near the new or old thresholds around this time. So 1st Jan 2026 is when the new FRS 102 is effective for periods commencing at this date. And so, as we flagged, 31st December 2026 for a 12-month reporting company, that's the first year end under the new basis. There'll be preparation of accounts and audit in 2027 according to your timeline, and a December reporter would need to file financial statements by 30th September 2027. And there are some other changes coming in at Companies House in terms of what you need to report. They will certainly be in play by then. What we would say, whilst 2027 may seem quite a while off, for companies that want their management reporting month to month or their quarterly reporting to be in line with what they will ultimately statutorily report for 2026 in 2027, now is the time that we need to start thinking about these changes so that you don't have a big shift when you come to report your statutory financial statements from what you've been reporting all along to those stakeholders as part of management reporting. So that outlines the timeline there. We're going to get into the detail now of lease accounting. So David, back to you.
Thanks, Aron. Yeah, so lease accounting and what's changing. I think it's fair to say that the changes to the leases will have the widest impact across most companies, albeit it may not be the most impactful if we compare it to revenue, which has much more scope to be impactful. But I think as a generalization, most companies will be impacted by these leases changes. And what are the key changes? Well, it's a brand new lease accounting model. So as Aron mentioned, or touched on, the distinction between finance leases and off-balance sheet operating leases, which were previously disclosed only, that distinction is being removed for lessees, and the rental expense on operating leases, which was previously been recognised in the P&L, will no longer be visible. So under the new approach, that rental expense is going to be replaced with finance cost and depreciation, and that that comes from the on-balance sheet model, where we're recognizing a lease liability, which is recognized at the present value of future cash flows, and that's discounted either at the incremental borrowing rate or the obtainable borrowing rate, and then a corresponding right of use asset on the balance sheet, which is depreciated over the term of the lease. So it is worth noting that those changes, as I say, will primarily impact lessees rather than lessors, but it will mean that balance sheets of companies will look quite different. And as Aron's flashing here, operating leases are no longer distinguishable from finance leases. They're all going to be recognised on the balance sheet as an asset and liability, with corresponding depreciation and interest being recognised over the lease term.
Yeah, we'll work through an example in a moment, won't we?
Yes, exactly. We'll work through an example, and again, touching on who will be impacted, it's going to be almost all clients who rent property, vehicles, IT equipment, or machinery, and we suspect that will mean almost all clients, because almost all clients will at least rent their property, although some may obviously not. In terms of the highest impact, what sectors are we going to see the biggest impact in? It's likely going to be retail chains with shop leases, professional firms with office leases, or SMEs that have company car fleets or photocopier contracts. All those kinds of arrangements will be within the scope of the changes when they come in January.
Yeah,
and
there's
just
not many exemptions at all, are there?
No, there's not many exemptions. There are exemptions for low value and short term leases, certain asset categories, but by and large, any asset that is controlled or you have a right to use for a distinguishable period of time will be viewed as a lease, which will be recognised on balance sheet. And just an important point on this slide as well, with regards to embedded leases, there may not necessarily be a separate lease contract for all the assets that should be recognised under the lease arrangements. They could be embedded within other contracts. And the classic example here is the exclusive right to use a server, which could be embedded within an IT contract. Yeah, so in terms of transition, it's important that the transitional basis here will be on the modified retrospective approach, which essentially means that there will be an opening reserves adjustment on the opening period of the current reporting year. So if we assume that will be from the 1st of January 2026 and the year end will be the 31st of December 2026 for the first year, that there'll be no comparatives restated in the previous year, but you will see an opening reserves adjustment on the 1st of January 2026. And that applies to leases only. The standard doesn't allow retrospective application of the changes, comparing that with the revenue changes that are coming in, and we'll touch on later. There is an option to either apply the cumulative catch-up approach similar to leases, or fully restate prior years. But obviously that does draw other areas of work, because you have to go back further and look at more historical contracts. Yeah, and then as I touched on, there are very important practical experience to be aware of. The main two relate to short-term and low-value leases, but there are other transitional experience as well that should be kept in mind, such as being able to rely on existing assessments of leases as at the date of transition, or if you're reporting to an FRS group, being able to use those calculations on an FRS basis at sub-level in those subsidiary accounts. So it's good to have an awareness of all the exemptions available on transition, so there's not work that isn't necessary that's being completed.
Yeah. Okay, should we take a look at a practical example? Let's see how this works. So let's imagine you have a 5-year property lease in your company. Let's imagine it's a new lease for the purpose of this. We'll talk about the opening reserves on a lease that is already partway through its life as at the 1st of January 26. So a new lease starting for 5 years. The cost, my cash flow, will be £10,000 rental payment per annum. And I know that I've got a 5% discount rate. Let's take that for this example. There's a few ways that can be calculated, but for this, let's assume a 5% discount rate. So under the old FRS 102, how I would currently report this is a £10,000 expense every year going through my profit and loss to reach the 50,000 total by the end of the 5-year lease term. And that would match the cash flow. That's probably quite a familiar thing that is happening there. So that's going to change. How it works now, at the start, and I'll show this with a graph in a moment as well, you would recognize both a liability and a matching right of use asset on day one, which would be the present value of those minimum lease payments. So that 50,000 in total discounted back to the start using that 5% discount rate. So for the purpose of this example, it comes out at around £44,000. So that's the day one double entry: debit the right of use asset and credit the lease liability, splitting current and non-current on that liability. Then how do I roll this through its life? So depreciation on the right of use asset is straight line. So the life, the 5-year on that 45k day one entry. So let's call that the £9,000 per annum. But the interest charge changes. It takes the shape of a curve. The interest rates are higher at the start of a lease term and lower towards the end of a lease term, similar to what we'd have seen on finance leases up until now. So we'll start at that higher rate and fall over time. So that total annual expense, whilst I will still get to 50,000 in total over the life of the lease, it's front loaded. My total debits to the profit and loss are higher in the earlier years of this 5-year lease term and lower in the later years, even though it arrives at the same total. So if I just show that, and the cash flows are unchanged by this. It's the accounting profile that changes. I still pay the same amount to my landlord, my lessor. So if we show this graphically, under the old method, it was just straight line, £10,000 per year to get to the 50,000 in total. But this red line is how this is going to behave in terms of total debits over the life of the lease under the new standard. And it's the total of both the depreciation that is still straight line and that changing pattern of interest costs that are front loaded. So higher in the earlier years, so 12, 11, crossover in that middle year, there's that 10,000, then 9, then 8, which will add up to the total of 50, but has a very different profile in any given year. So EBITDA, how's that changed? Under the old approach, my rent cost was in the E of EBITDA. I would deduct it from my earnings. So that was £10,000 less each year. Now, these costs are made up of depreciation and interest, so are not shown in EBITDA. So EBITDA increases under the new approach. And gearing as well. I had no lease liability. There was nothing really on the balance sheet in relation to old operating leases. There was a disclosure at the back of my future total commitment, but there was nothing on the balance sheet itself. Now I have a lease liability, so that might impact measures that look at gross liabilities, for example, my gearing ratio or my debt to equity ratio or things such as that. There are other changes too. So if we just hold this example in mind, how is it going to impact my financials otherwise? Gross assets are going to go up. I now have a right of use asset where previously I didn't have one before. And whilst we touched on earlier, company size thresholds have increased, overall my gross assets have also increased as a result of this change, bringing my right of use assets on. As I mentioned, EBITDA is going to go up. Rent comes out of the E, but it's replaced by some I and some D, some interest and depreciation. So EBITDA increases. My depreciation expense increases because now I'm going to be depreciating that asset and not having it as rental costs. Finance costs as well, any measures looking at that, any banking covenants that are based on a finance cost ratio, more will be shown in interest that was previously shown as rent expense. And with that front loaded profile in addition. Balance sheet gearing, as I mentioned, will go up. And there can be other ratios impacted. Net current assets, for example, I have a non-current asset in my right of use asset that comes on, but my liability is split current and non-current based on what I'm going to be paying in the next 12 months and what is beyond that. So it can impact that ratio too. And if you do have banking covenants on loans, they could be impacted by the change in these accounting figures. So you may need to discuss that with the lender so they're clear. They'll be familiar with what's taking place, one would assume, given this is a change to the whole standard, but it's still worthwhile having that conversation. I know people here will be very concerned about what's the tax impact if my accounts are changing. It's important to flag what we saw with IFRS 16 when that was brought into IFRS reporting is that from HMRC's perspective, because the cash flows aren't essentially changing and over time it all levels out to get to the right level, HMRC didn't want to see too much impact in terms of the total tax take. So over time, they will receive the same amount and are happy for the tax to follow the accounting in that way, even though it's changing, to ensure that change doesn't happen. Let me just flag what we mean there. So a new asset and liability, it changes the timing of expenses, and we've got this depreciation and interest instead of rent. That was what we said in the accounting bit. So for tax, so HMRC would want to see the depreciation and the interest on the right of use, or the depreciation on the right of use asset and the interest on the liability still deducted from profits in the year as part of the tax computation. Care needs to be taken here. We often add back depreciation and take capital allowances. That's not what should happen with right of use assets. You want to allow that depreciation as a proxy for the old rental costs. Where you have a lease that is partway through its life when this kicks in, that initial accounting adjustment to reserves is spread for tax over the remaining lease term to ensure that HMRC still nets the same amount by the end of the lease. And taking it in total, there's no change in the overall tax that one will have to pay, but the timing of when it's recognised could change year to year. Other tax considerations, so the gross assets test, there's tax considerations that use gross assets as a measure. They would be impacted too, similar to company size thresholds. We would encourage our clients and anyone who we're working with to retain old lease records in case you need to reconcile tax in the future. And of course, deferred tax may arise where different temporary timing differences occur as a result of these changes. So whilst the broad headline is HMRC see this as a tax neutral impact, of course, because the accounting is changes, there will be changes that need to be factored in and reconciled through. And we and our tax teams are here to help and support with that if needed. Okay, David, were you going to touch a little more on company size thresholds?
Yeah, indeed, Aaron, thank you. And just touching on this in the context of the changes to the lease requirements as well, as Aaron touched on there, bringing leases onto the balance sheet will impact the gross asset test from a company size threshold point of view. So while there was a 50% increase to the company size thresholds effective for periods after April 2025, so the small company turnover threshold rose from approximately 10 million to 15 million. Equally, the gross assets from around 5 million up to 7.5 million. These changes will have an impact on that second gross asset test, because if you've got a company with a long lease and it has to bring that lease onto the balance sheet and recognise a right of use asset, it could be the difference between companies that qualify for the small companies threshold and companies that don't qualify for the small companies threshold. So this slide's really just a health warning, really, that if clients think that they're going to benefit automatically from the increased company size thresholds, it's worth considering their lease portfolio and any impact that might have on that assessment, because they may be they may feel that they're going to get the benefit of that before they've done that assessment, and it could be incorrect. Yeah, and from an audit requirement, obviously, the company size thresholds will follow through. So if your lease portfolio means that you're not going to be meet that second threshold on the gross asset test, there is still a risk that you may need to be audited, and it's a case of, I guess, trying to work that out sooner rather than later, so that you're prepared for what you need to do.
Yeah.
Right?
Yeah, indeed. Okay. Yeah, fine. And that 2-year rule, as I mentioned, if you're hovering on or around the thresholds, best to consult. It can be complicated, and that impacts the audit requirements too. Okay, into the revenue part of the presentation. So I will touch on some of the technical aspects here, and then we're going to work through an example for you. So revenue, what is changing? So up until now, the current approach, we look at revenue recognition carefully, and we consider, when do the risks and rewards transfer? You've had that conversation. Perhaps when are things invoiced, or when have I earned overall my total revenue? That changes. A new approach, particularly for revenue that has a contract that spans a period of time, analysis is needed to match when the revenue is recognized at the different stages of that contract to when the different performance obligations under that contract are delivered. So for most straightforward sales, and particularly if you're selling goods, not much will change. Your performance obligation and the timing of the cash receipt, the consideration receipt, it isn't really impacted so heavily here, and you wouldn't necessarily see a change. However, for contracts that are multi-year, where goods and services are bundled together, there's more than one product that's offered as part of the contract, or if there's things like variable pricing, revenue timing may shift forward or back depending on the detail of that contract, the performance obligations, when they're discharged, and the consideration as it relates to each of those performance obligations. And it effectively is moving FRS 102 to align to what is in IFRS 15 as the 5-step model. So here's the 5-step model, highlighted step by step. We need to, number one, identify the contract with the customer. And companies should be aware that a contract isn't only a bunch of signed papers with a wax seal in a big box. When you walk into a shop and you buy a product, there are contractual things that take place. I can return a good if it's faulty. There may be a warranty on the product. There's certain two-way transaction conditions that are taking place. And so a step to identify those contracts is key. What are then the performance obligations under that contract from the seller to the buyer? What's the transaction price in total, the consideration? How do I allocate that transaction price? Step 4, how do I allocate it to those differently identified performance obligations? And then having matched the price to the obligation, that's when I then know when to recognize revenue. As those obligations are satisfied, I recognize the component of the price that relates to it, having satisfied that performance obligation. So that's the thinking and the theory that sits behind it. And there's a lot that can be seen. We can only sort of skate along the top of the 5-step model today. But David, if you want to bring it to life with a bit of an example, that can highlight things for our audience.
Yeah, I think an example is a good way to go. And I think it's worth also noting, just before looking at the example, that there may or may not be an impact for this for companies, regardless of how complex their revenue arrangements are, because some companies may I mean, the intention of the model is to recognize revenue to depict the transfer of value to the customer. So companies may already have done that. They may not have done it under this 5-step framework. The thing that this does is that it forces all companies to do it under the 5-step framework, so that they're all reviewing their contracts on a consistent basis. So I think that's just important to say that it may or may not be impactful. I think the current approach allows for more interpretation, whereas this is a bit slightly more rigid and process driven.
Yeah, and I've seen that from an audit perspective. I think UK companies have already been thinking carefully about when to recognise revenue. And if you're audited here, you may have had challenges of that nature. When do we actually meet the contract? How far through are we this milestone? And effectively separating the cash pattern from the revenue recognition pattern is something that is familiar. And if that analytical thinking is in place, there may not be an impactful change here. But like you say, David, this does introduce a certain rigidity and a certain proving as to when those performance obligations are discharged and which aspect of the price relates to them, that may result in some companies having to make an adjustment or amend how they previously reported things. Okay, let's have a look at that example then.
So just a representation of the 5-step model. So I have an example here of a financial services company, FinServe, that provide fund administration and management services, and they've got a 3-year agreement to provide services to a PE fund. They've reviewed their contract and they've identified 3 distinct performance obligations. The first one being the onboarding and setup fee, which is paid up front. The ongoing administration and compliance, which is payable at 10,000 per quarter over the 3-year period, and a performance fee as well, depending on if certain net asset value thresholds are met of 20,000. So as I say, under old FRS 102, many firms recognise fees when invoiced or when work was performed overall, which in some cases could have been upfront. So looking at that first obligation, companies may have decided to book that and book that revenue on signing of the contract. Others, as Aron touched on, may not. They may spread that over the onboarding period. These 5 steps just force a review of that and introduce concepts of recognising revenue to depict the transfer and the performance of the obligations in the contract. So under the 5-step model, the first step is to identify the contract. So there is a legally enforceable services agreement over a 3-year period, and it's got 3 distinct deliverables: the onboarding, the fund administration, and then the performance reporting based on the NAV test. So step 3 is to determine the transaction price. So in this example, it's quite a straightforward one. The contract stipulates how much value is attributed to each of those 3 obligations. Some contracts may not. Some contracts may bundle, for example, 1 and 2, and charge quarterly over the 3-year contract for those 2 services together. And in that case, you would have to look at standalone selling prices for those 2 distinct obligations and allocate the transaction price based on those standalone values. But as I say, in this case, it's clear the 2 fixed components are 30 and 120k over the 3 years. But the performance-based target is variable and depends on future performance. And in that case, the new guidance requires management to make a best estimate guess of how much they expect to, or what's the likelihood of achieving that performance target, and allocating some value to that at the outset of the contract. So doing that, they say a 70% chance likelihood of achieving that target. So it's 70% of 20k, which is 14, bringing the total transaction price to 164. And then step 4 is allocating that transaction price back across the 3 distinct obligations. And then step 5 is the important bit. That's deciding when the revenue is actually going to be recognised and at what stage. So for the onboarding and setup, that will probably take a period of time. It may not be 6 months, but it may be 3 months. And if that bridges a year-end date, the standard would say that you have to recognise that revenue over that time that onboarding service is being provided. So not on day 1. The quarterly fund administration, obviously that's an ongoing service which is just recognised as the service is performed. And then in the case of 3, the performance reporting and the NAV test, 14k, that's the estimate of the total revenue for that part of the contract, and that will be recognised. That won't be recognised until that performance obligation was satisfied. So whenever they reach that NAV performance test, it'll be at that point in time that they'd recognise revenue in relation to that.
Yeah, and you sort of get movements every which sometimes it's going to move a revenue later, and sometimes it may move things sooner, and you deferred or accrued as well. So there can be wide-ranging impacts in several different directions as a result of what is happening here. Okay, so you want to touch on practical considerations?
Yeah. So in terms of the practical considerations, I suppose to contrast this to the leasing changes, I think the leasing changes will be much more widespread and impact more companies, but will be quite easy to detect. If a company has a lease arrangement, it's quite easy to identify. In terms of the revenue, I think a lot of the detail will sit within the contract, and it will force a review of contractual arrangements and performance obligations and variable consideration components and things such as that. So it will require potentially more of a deep dive into contractual arrangements with customers to be comfortable as to whether there is or isn't an impact. And yeah, I've put here some high risk sectors. So any sectors that there's a greater expansive time between the billing and the cash being received. So immediately you think of construction companies that have milestone billing arrangements or have various different components to the contract. SaaS and software companies where they may provide bundled license and support, but all under one fee, and it's a case of having to unbundle that and work out how much relates to the fee and how much consideration relates to ongoing support. And similarly, manufacturing where there's warranties, rebates, or any component of variable consideration. But it is worth making the point that unless you're a very simple business, you will need to review contracts on some level, because these changes will have more likely to have higher impact in certain sectors, but generally they're sector agnostic, and most companies will at least have to review their revenue arrangements to make sure they're not impacted.
Yeah, there's a bit of thinking, isn't there? I know I think it from an audit perspective. If I put myself in the shoes of the customer on the other side of the contract, what do they think they're receiving as part of this arrangement? And if it is a good with a 3-year service contract and that's what they're paying it for, even if they pay all of that on day one, I must allocate some of that price to the 3-year element, not just the microwave or piece of technology that I've delivered on day one. That's what they perceive as receiving as valuable under the contract.
Exactly, and that's the measure as well, rather than what you think you're transferring in terms of value. It's what the customer perceives as having received the transfer value at that point in time when the revenue recognition kicks in. So that's a good point, Aron. Yeah, and just generally as well, I mean, if we think about it broadly, these are FRS changes that are being brought into FRS 102, and FRS is targeted at bigger companies with much more complex revenue arrangements. So just naturally, it introduces more judgments into the accounts of smaller companies, and some of those judgments are around the likes of variable consideration and likelihood of achieving targets, and then also whether or not services are performed over time or at a point in time, and that can differ as well by revenue type and industry. And then allocating that transaction price to the different deliverables, there's an element of judgment in that. I mentioned if it isn't clear in the contract, having to arrive at standalone for value of services and things such as that. There's just more judgment required. And as Aron touched on as well, unlike the leases, the direction of change isn't guaranteed. It can be an acceleration of revenue depending on what the previous accounting policy was under FRS 102 existing, or it could be it could go in the opposite direction. So it just really depends on the current treatment and how the five-step model impacts that revenue recognition pattern.
Yeah, and that's where those cash flows will impact as well, because the cash hits the bank, you've got the debit to cash, the credit may have to go somewhere, and revenue might not be the right place under a revised consideration, and maybe deferred until you have met those revenue recognition criteria under the 5-step model. Okay, I think that was a whistle-stop tour through leases and revenue. There is a lot to consider and talk about here, and we just wanted to introduce the key topics. We're going to move on now to talk about some of the other changes beyond revenue and leases under the updated FRS 102. It is worth flagging, I feel like leases and revenue are kind of hogging the limelight of these changes, and it's what the whole industry is talking about. But it is worth noting that they're not the only changes that have been brought in here. So David, well worthwhile you touching on some of the other changes that we can expect.
Yeah, and I suppose that there's good reason for the focus on the revenue and leases in one way, but equally these other changes have to be considered, to comply with the new FRS 102 as well. So I don't think it's worth dwelling too much on them, but just to flag that there are other changes being brought in to certain areas, such as the supplier finance arrangements. There are new disclosure requirements, and they were actually effective from the 1st of January 2025. The only changes that impacted this financial reporting year. All others are effective from the 1st of January 2026. And
It's
there are
worth
more
touching on
disclosures.
that point again. I was going to say on early adoption, you can't cherry pick which bits to early adopt. If you did want to apply it sooner, you have to apply all of these changes and leases and revenue. So yeah, anyway, what else is in there?
Yeah, exactly. So more disclosures to financial instruments and share-based payments. And then just to reiterate again, there are significant expansion of disclosures around judgments, estimates, and sensitivities. So there will be more reliance on management's input around those estimates and judgments. And if you're an audit, if you require an audit, expect your auditor to want support for those judgments that are informing the result. Yeah, and that's the key message, that leases and revenue will dominate, and probably rightly so, but the other changes shouldn't be forgotten about at the same time.
Okay. And yes, we had a couple of preliminary questions around Section 1A and small companies. What do they need to be thinking about?
Generally, less leniency around disclosures compared to the previous Section 1A, and much closer alignment with full FRS 102 in some key areas. So the Section 1A follows the recognition and measurement requirements of full FRS 102. That's important to make that clear at the start. What it does do is it allows small companies to avail of certain disclosure exemptions in certain circumstances. And the key point is here that some of those quite useful exemptions are being taken away, and I've listed them on screen here, probably just to draw attention to a couple of the most important ones. The related parties. So previously there was an exemption allowed if the related party disclosures weren't required in order to give a true and fair view. That's been removed. The related party requirements are now in line with full FRS 102, so there's less leniency and removal of that true and fair assessment. So it takes some judgment away from directors around that. And similarly, on the assumption of going concern under previous FRS 102, unless there was a material uncertainty around going concern, you could apply an assumption of going concern. But under the new requirements, that assumption no longer applies, and there will need to be a statement around going concern in the accounts for small companies. So they're the main changes to FRS 102 1A.
Yeah,
and that's the key, that they will look more like full FRS 102 accounts.
Yeah, that sort of true and fair override that's even in there now, whereby you need to disclose more than just the bare minimum of 1A in order to give that true impression to the user. That becomes more relevant now that there are changes to full FRS 102 that a 1A reporter may need to disclose to give that full, clear, transparent picture of their financial position and performance. And smaller subsidiaries that end up being audited because they're part of a large group will find auditors saying more needs to go in than what's gone in the past. So definitely one to be aware of. And of course, as we were saying, the recognition and measurement is the same. So everything we've said about leases and revenue applies to 1A companies. Okay, right, we're getting towards the end of the presentation. So if I pull things together as a summary, and then Lucy, if you help us out with some of the Q&A that may have come in. So if I go back to this slide, what did we want to do with you today, and what have we managed to get through? Technical accounting, it was a whistle-stop tour through what are some of the most significant changes to UK accounting that we've seen, and certainly the biggest changes since FRS 102 was released back in 2015. But we touched on the technical accounting, what needs to be thought about on transition, and then through the first period and beyond, both of leases and revenue, and we showed an example of each. We talked about the timing and showed that timeline. It is from the 1st Jan 2026, it's periods commencing. So for a 12-month reporter, it's to December 26. That's the first year end where you'll need to show these changes in the financial statements. But of course, those that want to align management and statutory reporting need to start thinking about the changes now to not have a big shift at the end when those financial statements are pulled together. And we touched on the tax as well. Certainly on leases, the expectation from HMRC is that because cash flows remain the same, tax over time will ultimately level out to be the same. On revenue, though, the tax will still follow the accounting. So changes that are made to revenue recognition patterns will play through to the profits chargeable to corporation tax that form part of your tax computation. So there could be a change there from what may have happened if the old method was stuck with. We talked about the wider impacts, what might happen to some of the other thresholds that you report against, what to think about in terms of full IFRS transition and the interplay with other standards or group reporting potentially. There's a lot that's changing here and needs to be thought about. In terms of systems and controls, we didn't touch on every single detail here. I suppose it's difficult with the audience that we've got and the range of sectors that it covers. But understanding the lease arrangements and having your revenue contracts in place and knowing where those documents are is the first step. Training yourself on the new standard. And I would say if you Google FRS 102 today, the standard in place is the new one. And all of this can be seen and read on the FRC's website. That's the first step. And then, of course, using us to help and assist with what you may need in order to ensure that you're ready for this and can achieve what you need for your business in terms of what you're reporting internally and to other stakeholders. And of course, for anyone who is subject to audit as well, ensuring that everything is in place for you to have a smooth journey through this transitional period. I know it's October 25 now, 31st December 2026 may seem like a way off, but in my experience, it will be here before we know it. So thank you, Lucy. If you want to wrap things up and move to the Q&A, would appreciate it. Thanks.
Yeah, thank you, Aron, and thank you, David and Aron, both of you, for your insights today. There was a lot of information to digest there. The slides, as said at the beginning, will be shared around shortly afterwards with all attendees. But there have been some questions that came in prior to the webinar. There's questions coming during the webinar, so we'll try and get through as many as we possibly can in the time that we've got left. So a question regarding leases, going back to leases, I don't know who wants to take this, but how will the value of the asset be assessed?
David?
Well, yeah, I'll pick up on that. I'll try and interpret what I think that means.
I think,
so the start.
Sorry, go
on. I think it's based on the key principle is that the asset is based on the present value of the cash flows associated with the lease. So I think Aron in his example had referred to the 5% discount rate. So it was a 10k lease over 5 years. So discounting that at 5% arrived at a lease liability of 45k, and that's also your starting basis for your right of use asset, 45k, and it's that value that is depreciated over the term of the lease. There can be circumstances where there's more to it than that. There may be costs to restore the property at the end of the lease, and if they're known within the lease arrangement, you would add those on to the right of use asset cost at the start, and they'd be included in your depreciation profile. But just for a simple example, your right of use asset is valued based on the present value of your lease and cash flows at the start of the lease.
Yeah, and I'd add to that the sort of it's the same way that you would calculate a finance lease, even under the old model. And if you haven't had one in your business for a while, might have to crack open the dusty accounting textbook. But things like some of the digits and that formula to work out the discount rate back is the way that you get from the cash flows in total to the day one value. But by discounting those back, and of course we can assist with that in addition. The other point, and I suppose this is the difficulty here, is that often finance leases, where ordinarily you're measuring it for the whole term of the asset, so a car hire purchase, and so that contract is normally written on a 5-year basis, and the total amount of the cash payments adds up to the value of the car plus the interest, depending on the deal that you've managed to secure for yourself. So in the finance lease world, was sort of built towards being able to calculate those day one values. In the operating lease, in the rental world, it's not really that way. The arrangement you'll have is to rent the building for X number of years at X cost per year, but that's not framed as you purchasing a value of that asset. So a little bit more work may need to go into that calculation of the day one value. And especially if you can't work out the interest rate implicit in the lease, you may have to use your obtainable in borrowing rate that you have as a company to calculate it. There's just a little bit more that needs to go in than a straightforward finance lease. But the fundamental answer to the question is, as David said, the present value, the minimum lease payments gives you that day one right of use asset and finance lease liability entry. They then play out over time. The asset's depreciated. The finance lease liability goes up by the interest and down by the payments, and they meet again at the end at zero, even though they take a different path through their lives over the lease term.
Okay, thank you both. Very concise answer. Moving to revenue now, I have a question. How can we apply the new 5-step model to a contract spanning over 2 to 3 years, but is time and material?
So a time and materials basis. Yeah.
I assume so. Yeah.
So for those that I'm familiar, that's where say a solicitor, for example, that's a good point. You might agree up front the rates, but as the solicitor works on the case, they will bill the time that they've worked on and any materials or expenses that have happened. So I suppose my thoughts, but David, feel free to add. I mean, with that variable pricing, it's not known. It's only earned as the performance obligation is discharged. So you wouldn't necessarily see a change here because the two are fundamentally in tandem with each other. As I do the work, I earn my consideration at the rates that have been agreed. So whilst that may span, that contract goes over time, revenue recognition is happening in total parallel between the performance obligation and the cash receipt. So revenue recognition would follow the same pattern that it has in the past. I don't know, David, are there other considerations there to consider?
No, I think that's right. Aaron, I mean, in that example, you don't know what the contractual or the transaction price is. If it's on a time and materials basis, and what is the gap between, or what's the period of time between billing and getting paid. I think you're probably going to, I would imagine, bill monthly, and you don't really have that. You don't have that accrual issue. It becomes a trade debtor as soon as you bill it. So there's less scope. It's where there's a contractual price to a contract, and you're trying to under the 5-step model, you're trying to assess when is that revenue going to be recognized and what components of the contract does that revenue relate to, and is some of that upfront and is some of that later. So it's not as complicated as that when you're billing on a time and materials basis.
Yeah, it's that fixed fee that the opposite to time and materials in a way, where you agree the fee up front irrespective of the time and materials that may be used. That's the key one to think about here, because on a 2-3 year contract, billing that at the end when everything's done, I mean, that feels slightly wrong under the current way we do things, but that's certainly wrong under the 5-step model, where it needs to be considered what are the obligations under that contract, when are they discharged over time, and which aspects of that fixed fee relates to which obligation and should be recognised in line with when they're discharged.
Okay, thank you. Please, can you run through the opening reserves impacts again and remind us when this context applies?
This is David's specialist subject, so I'll let him take this one.
I don't know. I think there's probably two parts to that question. There's the which periods are impacted, and then there's the how are the reserves impacted. So I think the first, to address the first question first, it could be potentially complicated in the first year, because you could have a scenario where you're restating opening reserves and the opening comparative reserves as well. If you decide to fully adopt the revenue changes fully retrospectively, you're going back to the opening of the comparative period and restating your reserves at that point in time. If in that case you also have a lease, you're not allowed to do that. So you have to restate the current period opening reserves for any lease adjustment. So in that scenario, and it's very possible that companies will have want to fully restate from a revenue point of view, but they can't from an operating lease point of view. If that applies, it's gonna look quite messy, and there'll be quite a lot of reconciliation needed in the first set of financial statements under the new guidance. In terms of how that impacts, if we look at the lease example, obviously on a day one point of view, if we say that the adjustment is going to take effect on the 1st of January 2026, just by way of example, you're looking at leases in place potentially prior to that. So you're going to be bringing on a right-of-use asset and a right-of-use liability, which you're going to calculate at the start of that lease term, but they're only going to come on at the values that they are on the 1st of January 2026. So depending on, obviously, the depreciation and interest profile are different on those two elements, so you're going to have a mismatch over the life of the lease until the very end, whenever the two catch up. So there's going to be a case where you've got probably a higher right-of-use asset and a lower lease liability, and it's what do you do with that adjustment on the 1st of January 2026, and it's that is reflected as an opening adjustment to retained earnings within reserves.
Yeah, the way I think about it, and if I relate to my example, that sort of did do, should do way of thinking, if I imagine I'm 2 years in, or at the start of the 3rd year, so I'm at that 10,000 meeting point of the two lines. So what I did do in the past was recognize 10k and 10k for the rent expense, but under the new way of doing things, I should have recognized 12k and 11k before getting to the 10k. Now I'm making the change. In future, I'm going to have the lower expense at the back end of the lease, but I haven't had the front end, so I've got that mismatch there that I need to adjust. And I don't do it in my comparatives, I do it in my opening reserves, because I'm not restating the comparatives. And that's the bit that also ensures tax-wise it reconciles, because I spread that over the remaining lease term as well to ensure I get back to the same total. So that's how I get it straight in my own head. But it is a complicated part of this, what to do with opening reserves on a lease partway through its life at the commencement date. So yeah, thanks.
Okay. We've got just a couple of minutes left. I'm not sure whether we have time for any more questions, I'm afraid. But thank you, everybody, for joining us this afternoon, and thank you, Aron and David, for your insights. If in doubt, consult with us. We're here to help. If you'd like to find out more, please scan the QR code that's on the screen now, where you can access all of our FRS 102 videos for more information. And please get in contact with your usual BKL contact, or if you don't already work with BKL, please contact FRS102@bkl.co.uk, and somebody will be more than pleased to help you out. Thank you again for joining us this afternoon, and we look forward to being in touch.
Thanks, everyone. Thank you.
Thank you.